Welcome back everyone. I hope you're having a great day. And in this video, we're going to discuss 3 tech companies who have fallen from their highs and may be on sale at their current level. And the entire tech sector has seen a slight pullback as of late, and now may be a great buying opportunity to get into some strong brands with great future growth potential at nice valuations. And in the market right now, there are a ton of tech companies that ran up too hard and too fast throughout 2020 and into 2021. So the tech brands with sky-high valuations, forward PEs of 100, 200, or 300, and they have very little revenue and are still losing money every single year, those are the companies you may want to avoid in this current market environment that may be poised for a pullback over the upcoming months. But in this episode, we're going to discuss 3 tech brands who have strong fundamentals, growing revenue, strong cash flow, and nice balance sheets that they'll be able to weather any storm in the market going forward and will continue to grow, I believe, for many years to come. So for each of the companies, we're going to take a look at their current operations, their current dip, which is why they may be on sale right now, and the future growth potential for all of these names going forward. But before we take a look at stock number 1, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for daily videos. And one thing I want to mention before we take a look at each company individually is that most investors are scared when the market goes down, when that's the completely wrong mindset. For example, as a consumer, when you go into a store, and we'll pick Walmart for example, if you go into Walmart and you find a product that's on sale, you believe it's a good deal and you may purchase it because you can buy it now for a cheaper price than where it was last week, the month before, or where it's going to be in the future. The same thing goes with the stock market. If you like the companies, if you believe in them long term, and you want to invest in their brand, why are you getting scared when the stock falls 10, 15, or 20% from its highs? These companies will go up and down. The stock market is volatile in nature. Companies just don't continuously go up. There's going to be dips in the market. So if you buy strong companies that are going to be there 5, 10 years in the future, they have strong operations, they generate profits and cash flow every single year, now is the time to buy when they fall. It's not time to be scared and pull back. It's time to go higher into the market, deploy more capital, and buy more shares at a cheaper price. So you got to understand, as a consumer in stores and online shopping, people like to buy during sales. But when that happens in the stock market, individuals and beginner investors get scared and pull away. But I want to kind of help you with your understanding of the market, and next time you see red in your portfolio, help you view it as a buying opportunity rather than a time to be fearful. And now if we move on and take a look at the first stock that is on sale right now, they've fallen from their highs, but they're still a strong tech brand. I believe that's going to be operational for many years to come. It is ticker QCOM, which is Qualcomm. They trade for $134 per share, and over the trailing 12 months, they are up by 81%, and the company has a market cap at $155 billion and trades with a forward PE of only 17.7 and a nice dividend yield right at 2%. So this is a tech growth company that offers a nice 2% dividend and is trading to what I believe to be a very reasonable valuation with a forward PE right around 17 to 18. And if we take a look at their shorter term price movement, from a high point of $164 per share, they have fallen by over 18% back down to their current level. So this is the equivalent of going to a store and seeing one of your favorite products on sale for 20% off for that period of time. So that's what we see in Qualcomm stock at this current level. And if we take a look at their recent financials from their Q1 2021 report, they generated record high quarterly revenue of $8.2 billion, and all 4 of their business categories saw incredible growth. Handsets grew 79% year over year from $2.4 billion back in 2020 to $4.2 billion in this past quarter. Their automobile, Internet of Things, all of their different product categories saw immense growth over this past quarter, which is incredibly impressive. And going forward, the company still has plans for future expansion due to future development of 5G. And throughout 2021, they believe there's going to be around 450 to 550 million smartphones with 5G manufacturing. But going forward next year throughout 2022, they believe that's going to expand to over 750 million next year alone, and going forward, those numbers are only going to continue to grow. So they believe their chips and their different processes have a ton of future expansion over the upcoming years. And although this is a growth play, the company does pay out a growing dividend, and over the longer term, since back in 2011, they have consistently increased their dividend payment every year or every other year. And over the past decade, they've returned $96 billion worth of capital to their investors in the form of dividend and share buybacks. So the company is focused on their shareholders by returning capital, has great plans for future expansion, and over their latest quarter set a record high in total sales. And if we take a look at their dividend, that yield right now comes in at 2%. Their payout ratio is extremely sustainable, making up only 35% of their net income, so a lot of room to continue to grow that dividend while reinvesting in growing their current operations, and their 5-year dividend growth rate average is at 6.5%. And if we take a look at Qualcomm financial statements, which is why they're included in this video, this is a very healthy company. If we start off with the income statement, they generated consistent and growing revenue with some nice expansion as of late to over $29.4 billion in the trailing 12 months. And if we take a look at the bottom line, they are a profitable company with over $8 billion of net income over the past year as well. And of course, when evaluating the financial health of a company, you got to take a look at the balance sheet. So right now, this company has short-term assets available to them within the next 12 months of over $18 billion. And if we compare that to their short-term debt of only $9 billion, their current ratio, which is current assets divided by current liabilities, comes in above 2, and that's very strong and very sustainable. And overall, the company has total assets of over $37 billion. And as they continue to grow year over year, one thing that I want to point out is that goodwill and other intangibles are actually going down. And these are two assets that are non-monetary in value. You can't trade goodwill for any dollar figure, but these join the balance sheet when companies make acquisitions. So if you see a balance sheet with growing goodwill and intangibles, that means that company isn't really growing as fast internally, rather they're acquiring other businesses in order to grow. But Qualcomm is the complete opposite. Their total operations are growing, revenue is up to record highs, and they're not acquiring other businesses. They're doing it all internally through their very own research and development, which is incredibly impressive. And the total liabilities on the company come in at around $30 billion, so a nice overall ratio for this company's balance sheet. And if we take a look at some future growth projections, and also expecting their share price to grow by over 27% per year for the next 5 years in the future, and at their current level of $134, they are considered a buy and well below the 12-month expectation of $171 per share, implying a ton of upside over this next year. So I think Qualcomm is definitely a company to take a look at right now. They have fallen over 18% from their highs. They have strong financials, a great plan for future expansion, and offer investors a combination of nice share price appreciation plus a 2% growing dividend. So definitely worth taking a look at their current level, and is the first tech company that I believe to be on sale at their current share price. And now if we jump into the second company in this episode, it's going to be ticker BABA, which is Alibaba. They currently trade for $228 per share, and over the past 12 months, they have grown by 18%. And right now they have a market cap at $625 billion, with a very low and very attractive forward PE of only 22.5. So right away, I do understand there's a lot more associated risk getting into a company like Alibaba, who is a Chinese consumer and tech brand. But their operations are so strong, and because of all the scrutiny they've been under over the past 12 months, the share price has been hit really hard. And we can see from their high point that came in at over $300 per share, they have now fallen from October 2020 28% to their current level. So I think the company has fallen too hard and too fast over the past 6 months to be worth only $620 billion and trade with a forward PE of only 22.5, which is below the market average right now for the S&P 500. And I think going forward, Alibaba's growth is going to outpace the general market, and their current valuation is going to be attractive when we see how fast the company can expand over the next few years. And although the Chinese government is still a risk when discussing this company, they did get through their first monopoly investigation and only have to pay a slight fine of a few $1 billion. And for many investors, that is a great sign. For the common person, getting a fine of a couple billion may be a major deal and think that's going to end the company. But when you evaluate Alibaba's financials, a couple $1 billion worth of fines versus what really could have happened to their business is only a small little feat and was actually a happy sign for the company. And if we take a look at their latest investor presentation, this company operates, of course, in their core commerce sector with a bunch of different websites and retailers. They also have a growing cloud business and are competing with some of the big names in the American industry as well for that entry into the cloud space. They also have some digital, media, and entertainment, and the company has some innovative projects as well. So when you buy Alibaba, you're buying into a lot, not just one single product or one single website. The company's doing a lot under their current umbrella. And if we take a look at the growth of their numbers, total revenue year over year has picked up by 34%, which is absolutely incredible. And if we take a look at some competitive numbers, total EBITDA is up 29% this year as well, and their total non-GAAP free cash flow grew 35% year over year. And if we take a look at their growth relative to their peers, they're outpacing all of the big American tech companies in terms of total revenue growth, according to their investor presentation. And their year over year profit growth has been beating their competition as well, just slightly going below Facebook compared to the American big tech. So right now they do believe they're positioned to grow and expand faster than the competitors over the long term and under their current valuation with so many different companies under their Alibaba umbrella, and they got through their monopoly investigation. I think the company does provide some nice upside from its current level. But of course, I'm not a financial advisor, especially when companies like this, you have to do your own research. In no way is this a recommendation. We're just taking a look at the numbers and the facts about this business. You have to form your own opinion and make your own personal buying decisions based on your current risk tolerance and what you expect to happen with this company over the long term. So I don't recommend any stocks on the channel. I wish I was a financial advisor, but I'm not. So maybe one day in the future, I will be able to make qualified recommendations. But at this current point in time, I'm still a random guy on YouTube. So make sure you do your own research. But if we take a look at Alibaba's financial statements, we can see on the balance sheet, they're in a nice, healthy financial position with over $91.5 billion of total current assets, and sitting in cash, they have over $70 billion. So over $70 billion sitting in cash on the balance sheet. So that's when I said, when they have to pay a $2 to $3 billion fine to the Chinese government, that's nothing for this company. $70 billion. This is in USD. This is on Seeking Alpha. They take all the company's financial reports, translate them into the US currency, $70+ billion worth of cash sitting on the balance sheet. So paying 2 to 3 in a government fine is really nothing. And if we take a look at their total current liabilities of only $54.8 billion, right now they have more cash coming on the balance sheet than their short-term debt, so a very healthy position over the next 12 months. And their total liabilities overall come in at right around, I'm going to say $86 billion. And with their current assets of over $91 billion, their short-term assets available in the next 12 months can pay off all of the company's debt on the entire balance sheet. So another very strong financial position, and over the long term, total equity has been expanding at a terrific rate, which is exactly what we want to see, to over $164 billion. And if we take a look at the income statement, year over year, their revenue has absolutely exploded, and why I think this company offers a very attractive valuation at this level, being underpriced compared to the relative market with revenue growth like this. Back in 2016, they had only $15.6 billion in total revenue. In a matter of 5 years, they've more than 5x'd their total sales and have gone from $15.6 billion to close to $99 billion of total revenue in the trailing 12 months. That's just absolutely insane. Take a look at this chart. Year over year, total revenue is growing exponentially at such a fast rate. It's almost incredible to even look at. And if we take a look at their bottom line or their profitability, this company has insanely high margins. $24.3 billion of total net income on around $99 billion of total revenue. So a profit margin right around 24 to 25% overall, which is very impressive. So the company generates billions of dollars. They generate growing sales annually, and that has no signs of slowing down anytime soon. with projected expansion of close to 40% in 2021 and then another 30% growth in 2022. So they're projected over the next 12 to 24 months to cross $143 billion of total revenue. And if we take a look at the future growth of the share price, analysts are very bearish, only expecting 3%, which I think is very inaccurate. And going forward, the company is considered a strong buy, coming in at a 1.7, and the current share price of $227 is well below the 12-month price target of $314. So right now, analysts do like the company. They do believe it's a buy, and going forward over the next year, they're predicting a ton of future upside. So this company, I think, has just been hit way too hard. The Chinese government is impacting the share price by all the different investigations, but the people in America have said Alibaba and the other big Chinese tech brands will not get delisted from the American exchanges, which is a good sign if you want to own the company. And they got through one of the tougher investigations with only a few $1 billion worth of fines. So although the company will have some high risk going forward, it's still going to be not as safe maybe as an American brand. But if you're looking for some growth at this current market environment with a very fair valuation, I think Alibaba is definitely worth doing some research into, trading with a forward PE of only 22.5, which is slightly below the average for the overall S&P 500 from a company that has very fast revenue growth, projected at 30 to 40% per year going forward, and a rock solid balance sheet with $70+ billion in cash, very little long-term debt, and can be very sustainable for many years to come. So this was the second company we're going to go over. And now if we continue on into the third and final company we're going to discuss in this episode, it is ticker AMD, which is Advanced Micro Devices. They currently trade for $78 per share, and this is a leader in the chip making and semiconductor space. And over the past 5 years, the company has absolutely taken off, expanding by over 2,000%. And in the trailing 12 months, they are still up 57%, even after their most recent decline in share price. And at this current level, they have a market cap of $95 billion and are trading with a forward PE of 37.5. And if we take a look at the recent decline, from a high point of over $97 per share, they have now fallen over 19%, back down to the $78 level. So I absolutely believe this is another big tech company that is on sale at their current share price. I love going to stores and finding deals 10, 15, 20% off, and you can pick up some AMD right now for 20% off. And if we take a look at their investor presentation, their growth has been phenomenal with no plans of slowing down anytime soon. And throughout the full 2021 fiscal year, they're projecting total revenue growth of over 50% while maintaining a gross margin right around 47%. And over the medium to long term, after 2021, they're still expecting major revenue expansion of 20% per year. They believe they can maintain a CAGR of 20% revenue growth over the longer term with a gross margin greater than 50%. And they do believe their profitability will improve with mid-20s operating margin and a free cash flow margin greater than 15%. So the company over the medium to longer term, so we're talking 3, 5, 10 years, is still projecting significant growth and expansion in their cash flows and their sales every single year. And if we take a look at their financials, total revenue has absolutely exploded. Annually, it's growing at a terrific rate, and over the past 12 months, it has picked up to over $11.4 billion in total sales and is trending in the right direction. And if we take a look at their bottom line or their net income, from you losing money every single year, this company is going in the right direction. They've achieved profitability back in 2018 and have continued to grow that to over $2.8 billion worth of profitability in the trailing 12 months. And why I like this company, and the same reason to why we've discussed Qualcomm and Alibaba in this video, is because when tech stocks are falling, a lot of the companies with extremely high PEs, over 100, with very little sales, that are losing money every single year and have no cash flow, those are the ones who are going to get hit extremely hard, and I believe will fall the 30, 40, 50% in value and may not fully recover. But like all the names we've already gone over, including AMD, this company has a very solid balance sheet. If we take a look, total current assets of $7.2 billion versus short-term debt of only $2.8. So a current ratio safely above 2 and very sustainable over the shorter term. And one thing I like about this company, very little long-term debt at only $3.5 billion in total liabilities. So 2.86 in current with a total of only 3.57, meaning they have less than $1 billion of long-term debt on the business. And if we take a look, long-term debt has actually been going down year over year. So the company's been paying off their debt without issuing any more and using their cash flows to fund their growth, which I absolutely love to see. And during tough times, which may be coming up for the tech sector, we will see no issues with AMD and they will remain operational for the longer term. And one thing I like to see as well is that their goodwill and their other intangibles are very minimal. And one thing that's very impressive is this company has exploded, meaning their other intangibles and their goodwill have barely moved. So that means they're growing naturally. They're not just making acquisitions to expand, because as you make acquisitions, your intangibles and your goodwill will grow, but that's not happening with AMD. So they're naturally growing their assets, their cash flow, and their profitability every single year for the past 5 years plus without just making acquisitions, and it's all coming with internal research and development. And going forward, their total revenue and expansion has no signs of slowing down, and they're projecting over 50% expansion in 2021 with another 15% growth throughout 2022. And like I mentioned, if we do go through any tough times, strong cash flow is what's going to get companies through, and AMD has proven they can grow their cash flow every single year. From having a cash outflow back 4 years ago of around 129 million, they have completely turned it around and have now reached some great free cash flow numbers of over $1.79 billion of total after expenditure free cash flow in the trailing 12 months. And if we take a look going forward, analysts are projecting some major growth from this company of over 28% per year for the next 5 years in the future. And at their current share price of $78, they are well below the 12-month expectation, coming in at 105. And right now they are considered a buy, coming in with a 2.3. Although it may be considered a slight buy at this rating, I think AMD, after this 20% decline in share price, is sitting at a very attractive level. They have great financials, their growth has no signs of slowing down, they're operating in a fast expanding industry as a whole, and like we saw with Qualcomm, 5G presents a great opportunity for all these companies to continue to expand. So that was the third and final stock we're going to discuss in this episode. And now if we do a little wrap up to close up the video, I want to thank you for watching to the end. And of course, in this episode, we discussed 3 tech growth companies that have fallen at least 15, 20%, or even 30% from their highs. And I believe they're on sale at this current level. And the analogy that I've used many times throughout the video is that when you're shopping at a store, you're attracted to the items that are on sale. But when you look at the stock market, people get scared of the companies who have fallen 15, 20% from their highs. People don't understand that means the stock is on sale. If they have strong fundamentals, nice balance sheets, growing revenue, and future plans for expansion, it may be a great opportunity to pick up some shares after that recent drop. So that's why for all these companies, I didn't just focus on some different qualitative aspects. We took a look at their financials. All of them have nice balance sheets, growing revenue and income, and have in place plans for expansion going forward. So those are the reasons why we discussed these 3 companies in this episode. So please hit that like button, subscribe to the channel for some daily videos, and if you really enjoyed it, leave a comment down below. I will take requests for future videos, different stocks you want me to go over, and I want to thank you for watching to the end, and I will see you in tomorrow's video.